What if I told you that one of the world's most valuable companies almost died in a single week? In 2008, Tesla wasn't the electric revolution we know today. It was a company teetering on the edge of collapse. But that very collapse became the foundation for one of the greatest comebacks in modern economics. In late 2008, Tesla was just weeks away from bankruptcy. The global financial crisis had completely dried up funding. And their first car, the Roadster, was way over budget and hopelessly behind schedule. Suppliers weren't getting paid, and waves of employees were being laid off. Elon Musk himself was nearly broke, after pouring in his entire personal fortune from the sale of PayPal. He later described it in his own words: "We were bleeding money like crazy. It was a perfect storm of disaster." Most people look back at this story and see either sheer luck or the work of a lone genius. But if you look at it through an economic lens, it's a masterclass in risk management and understanding opportunity cost. At that critical moment, Musk faced two brutal options. Option 1, shut Tesla down and protect what little capital he had left. Option 2, risk absolutely everything, including his last remaining personal cash for one final desperate lifeline. His decision wasn't just an emotional gut feeling. It was a calculated asymmetric bet. He understood that if Tesla failed, he would lose everything he had. But if it survived, even by a thread, the upside potential was almost infinite. He was betting on a future that no one else could see, where the potential reward dwarfed the catastrophic risk. So, he made the call. He invested his last $20 million into Tesla, just to keep the lights on for a few more days. And then, a Christmas miracle happened. On December 24, 2008, a last-minute $40 million funding round closed just hours before Tesla was set to officially go bankrupt. That capital injection allowed Tesla to pivot, restructure its operations, and later secure a crucial deal with Daimler. This was the start of its long road to recovery. In economic terms, this was a perfect example of extreme risk tolerance, meeting strategic timing. He made his biggest bet when the downside was already priced in by everyone else. Tesla's monumental success wasn't built on confidence. It was built on failure that was analyzed wisely. The 2008 crisis forced the company to simplify its operations, innovate under immense pressure, and focus on long-term survival instead of chasing short-term hype. And that's the real lesson here for any underdog. Whether you're rebuilding a company or just chasing a dream, failure isn't the opposite of success. It's the capital that funds it if you learn where to reinvest it. This was the Underdog Analyst, where failure meets economics. Join the pack. Be a wise wolf. But what if the smartest decision you ever made was quitting? In our next episode, the sunk cost fallacy in your career. When to quit a good job. We'll uncover the economics behind why staying too long might be your most expensive mistake.